Hello friends, welcome back. Today I am recording a short video on 5 common investing mistakes normally a lot of us make in our investing journey. These 5 mistakes are not exhaustive in terms of the number of mistakes one can make, but they are the most important mistakes needs to look at. If you are able to take care of these 5 mistakes, you will be able to achieve 80% plus success in your investing career. Let's get going. The very first mistake is investing reserve money for emergency. Normally, we earn, we save, we invest for future happiness. Although happiness and wealth may not be correlated directly, but in the physical world where we all are living, wealth is very important aspects, and most of us, unless you are a yogi, without achieving a certain amount of wealth, don't migrate into the region of happiness. Therefore, happiness one has to keep in mind in the journey for investment. What happens is many people do commit a mistake. They get excited with the growth happening in the investing market, or they get excited with the bull run, and whatever surplus money they have, they start investing. Normally, it's a good practice to have around 6 months of your expenses as a reserve, particularly during pandemic time, where the flow of fund, whether you are a salary earner or a business person, has got a lot of variation. There may be disruption, there may be cutting down of salary, etc., etc. So therefore, it is far more important for all of us to maintain a sort of liquid money reserve. When I talk about liquid money, what I am referring to is something like fixed deposit, something like debt funds, which can be encashed in a very short notice, and you have money in your hand to take care of your emergency. Now, many people, as I mentioned earlier, they do invest emergency fund. That is a big mistake. The market has got a lot of uncertainties. You need to keep in mind that your money is there to take care of the emergencies, exigencies. If you don't have that, you will land up in trouble, and many people do that. Many a time, people do take loan and invest in the money. So the advice over here is don't take loan or leverage position to invest in the stock market. When I say stock market, it could be even mutual fund, because mutual fund is also a part of the stock market product. So one should be very careful. I am reminded of a situation which I like to share with you. In beginning of 2000, during Harshad Mehta boom, that was the first boom which I remember, we are all very excited. We had a small investor group, and I was in Indore at that point in time. So we used to meet every week and discussing the different investment options and the likely future, the way we perceived. There was a gentleman, he was so gung-ho about the theory which Harshad Mehta was putting forward, that he not only invested each and every surplus penny he had, but also sold his house and invested into the stock market. And after a few months, the market collapsed. So you can imagine what could have happened to him. He was heading for a disaster, and he did. So friends, very first mistake to avoid is never ever invest the reserve money or money kept for exigencies in a stock market or in any investment avenue which has got a high degree of uncertainty associated. Moving forward, mistake 2. It's a very common phenomena in the market. Many times my friends will call me and say, give me some tips. I'm not a broker actually, but do I have interest in this area, and I have been in investing field for 40 years plus. Normally when somebody asks you for a tip, it is very hard to give a tip, but sometimes people insist and you will suggest something. Now the trouble over here is, if you have a habit of asking for tips, don't do that. I'm not sure how many of you have made money working on tips. Maybe sometime you might have, because sometimes it does work, but in totality, it never gives you a good return in long run. You will land up burning your money if you work on tips. Nobody can care for your money as much you can. So therefore, due diligence is very important for investing. You must get into details if you are investing yourself. details of the fund, details of the equity of the company, their financial position, the growth opportunities, and various market factors. I understand it is very hard for a working professional, whether he is a salaried person or in business, to get into detail and do a proper due diligence. In that case, my recommendation is do engage an advisor, because if you are not able to do due diligence and you go at the surface level, you are bound to take a undue risk and finally burn your investment. So therefore, you should never ever invest on tips or without doing a complete due diligence. Moving forward, mistake 3. Many times there are people who talk about timing the market. Like they may look at certain technical analysis or generally with their experience, and they would like to get into the market when it has fallen. Now there have been so many research worldwide, and timing the market is almost impossible. In fact, even though somebody invested, let's say 2000 onwards in Indian context, every year at the peak, and even today, he had a discipline on investing at peak. Still, he could have carried home a compound annual growth rate of his investment at 13% plus. That's the beauty. But here, one thing I'm trying to communicate is the discipline in investing. So, timing the market is almost impossible. The second thing which comes in, timing market is impossible, but time in the market is very, very relevant. I did a personal research on a data published by a very famous sites in India, and they keep on giving recommendations. And although it's a paid site, but what I found out is they give a rating of a stock in terms of, like 80%, 90%, 70% sort of. They give various other strengths. And also, then what I did was I ran a correlation regression analysis between various factors. And what I observed that all factors like rating given by this particular site and other factors were irrelevant or had a very poor correlation. Whereas staying invested had the highest correlation of about 0.9. So it goes without saying time in the market is very important and not timing the market. Moving forward, mistake 4, lack of asset allocation or diversification. I have had a video on diversification earlier. This is very, very important aspect. It is very difficult to really pinpoint a particular stock which is going to be the winner. But if you choose some potential winners, obviously based on analysis, and diversify or allocate assets in a different asset class like equity, debt, gold, real estate, etc., or even within the equity in different equity options or different equity types, you will be able to take home a better return at the end of the period. Many times I have come across my friends or some of the acquaintances who had invested in 15, 20 mutual funds because his advisor kept on suggesting him every time to do it here, do it there, and without realizing in this case that his return gets drastically reduced if you have too many funds because they overlap with each other and you are not able to really understand these funds. So therefore, even if you talk about mutual fund, it is very important to select proper set of mutual fund. Even adding a large cap fund and mid cap fund may not go with your risk profile. So it is very important here to understand the risk adjusted rate of return and finally invest. As I mentioned earlier, a good strategy could be reaching somebody who can give you a very honest opinion. There are not many in this world, in any field, where you get a very honest opinion, but you have to judge that yourself. And unless you do that, you will not be able to succeed in investing and endeavor. The fifth one and the last one, impatience or impatience as a result of greed. In a rising market, somebody makes a 30% gain and he becomes impatient. He wants to come out. Similarly, in a falling market, you lose 20%, again you become impatient. As I mentioned earlier, the timing in the market is very, very important. Therefore, friends, if you avoid the influence of greed, What I'm trying to say here is invest with a confidence. Invest based on facts after doing due diligence or referring to someone on confidence. Then trust that person, trust that individual, trust that investment. You will do much better. But remain invested in the market for a long time. It would be worthwhile to mention here Mr. Rakesh Jhunjhunwala is called as Warren Buffett of Indian stock market. And if you look at his portfolio, you can find out quite a few stocks at any particular point in time where he had incurred a loss of maybe 20%, 25% from the value he bought it. But you must have noticed. Or if you have not noticed, I request you to look at his portfolio and look at longevity of his portfolio, that he stayed in the market for a long time. So a couple of things which he has, which common people like me and you may not have, his confidence in a particular stock, because he invests after doing proper due diligence. And having done that, he stayed with that for a long time. And believe me, that is always going to give you a very decent returns. Friends, I have touched upon 5 important investing mistakes. I'd like to make a mention here. These are not all mistakes. You might have come across many other mistakes. Go on learning from your mistakes as well. These 5 mistakes could be very common, which many one of us keep on doing. But there could be many more mistakes. And investing is a journey where each day, if you are in the market, you learn a new thing. After being in the investing field for almost 40 years, I was not in investing full time for 40 years, but for the time I was in career, I used to give some time, but now I'm able to spend more time in the retired life. I keep on learning even today. So therefore, this particular video should be treated more as a guideline for learning. Feel free to share your experience, what you think about mistakes and how you learn from it. And if you like the video, please do subscribe to the channel so that we can get hooked up with each other. Do comment with your views. I'm giving my coordinates in the details. So in case you need any personal advice or you need any specific talk which you want to have for your portfolio, feel free to reach me. I'll be more than glad to work with you and take your investing goal to a newer height. Thank you so much for your time and stay safe. Thank you.